Hello everyone and welcome to section 4 in this course. So far in the course you have studied how support and resistance levels are placed on any trading instrument using the top-down analysis. While using the support and resistance strategy taught in this section, plotting zones is the first step of technical analysis you are required to perform. In this section I will add the second key indicator to this strategy in the form of key candlestick patterns. While support and resistance levels mark the foundation of this strategy, these key candlestick patterns you're going to study will build on the larger picture. Therefore guys, these candlestick patterns will look to answer the following key questions for you. How to identify if the sideways price movement is about to start on any instrument. How to take advantage of key support and resistance points within this sideways activity. And third, whether a market will pause or breakthrough will occur at these multi-year support and resistance levels. Guys, I'm not going to teach you the basics of candlestick charts as the information is available online for free. Instead, in this section you will learn about key candlestick patterns that you will observe carefully while using this strategy. It is because these patterns indicate the key price reversal near the major support and resistance areas, as you will learn. This also concludes the introductory lecture of section 4 and I will see you in the next lecture. Hello guys and welcome to the next lecture in section 4 where I will explain the first two candlestick patterns called the hammer and the shooting star patterns. As the name suggests, hammer pattern looks like a hammer. It occurs after a downtrend and signals bullish sentiment with the buying strength coming back into the market. On the other hand, shooting star is the opposite candle formation to hammer, and a shooting star appears after an uptrend and signals the bearish sentiment with selling strength entering the market. Let us quickly look at a typical hammer and shooting star formation using an illustration. A hammer signifies that sellers were able to push the prices lower initially before the buyers took control of the price, and the closing price is well above the opening price of the session. The lower tail or wick of the hammer candle is usually twice the size of the real body of the hammer. A shooting star on the other side brings a pause to the buying strength as the buyers were able to push prices higher early in the session before sellers are able to close the session well below the opening price of the candle. The upper tail or wick of the shooting star candle is usually more than twice the size of the real body of the candle. Please note that it is possible for a shooting star to have a small lower wick and for hammer to have a small upper wick. Guys, for both of these patterns, the lower tail for the hammer and the large upper tail for the shooting star is a sign of increased strength associated to this pattern. Now when it comes to taking trading positions based on these patterns, you will always consider following key points. Whether a shooting star pattern or a hammer appeared after a clear uptrend or downtrend respectively. This means that the importance of the pattern increases when they appear after clear market trends. Whether these patterns are also associated to key support and resistance zones on your trading chart. If this happens, you are able to trade these patterns with increased confidence. While one shooting star after a clear uptrend signals the bearish sentiment, however, if you see 2 or 3 consecutive shooting stars, then this is adding even more bearish sentiment in the market. Exactly the same guidelines apply for consecutive hammer patterns. Now let us study what we've learned in this lecture through examples. Guys, the first example is of pound and Japanese yen forex pair and we are looking at a shooting star formation. Notice how the price rallied in an uptrend on this pair before a shooting star appeared at this key support zone. Also notice the large upper tail of the shooting star, which explains that buyers failed to push prices higher during this trading session. In addition, following this shooting star, price fell sharply on this pair towards the next key level. Let's look at another example of shooting star. In the next example, we are looking at daily chart of euro-dollar forex pair. Once again, notice that the market was in clear uptrend prior to shooting star candle. Guys, I want you to compare the real bodies of the shooting star examples you've studied so far in this lecture. A shooting star indicates bearish sentiment, but a shooting star with a bearish colored body is of increased strength. Once again, price declined here, and another shooting star was recorded after few sessions before price declined sharply. Let us study another example of shooting star now on Swiss franc and Japanese yen forex pair daily chart. As you see here, after a clear uptrend, a shooting star appeared with a long upper wick at key support level, and price fell sharply after that. In addition, once price reached a key level which acted as a resistance, a hammer candle appeared indicating the buying strength on this pair as price went higher in a sideways movement. The next example is of hammer on crude oil daily chart. See how this pattern appeared on a major support level with a large lower tail indicating the buying strength in the market. Moreover, following this hammer, price rallied sharply towards the next key resistance level. Let's study one final example in this lecture. Now we're looking at pound dollar on a daily chart to study another strong hammer formation. The color of this hammer formation is also bullish, hence indicating increased buying strength in the market. And once this hammer candle appeared at a major support, price rallied sharply in an uptrend. Guys, this also concludes this lecture, and I will see you in the next lecture where we study another two of my favorite candlestick patterns. Hello and welcome guys to the next lecture where I will introduce bearish engulfing and bullish engulfing candlestick patterns to you. Unlike shooting star and hammer, engulfing patterns consist of two candles where second candle engulfs the real body of the first candle in the pattern. A bearish engulfing pattern is the sign of bearish sentiment as the real body of the second candle in this pattern engulfs the real body of the first bullish candle. Similarly, a bullish engulfing pattern indicates buying strength and thus bullish sentiment as the bullish candle engulfs the entire real body of the first bearish candle. Now let's understand these patterns using illustrations. Bearish engulfing pattern signals the selling strength in the prevailing market as buying strength weakens, which is reflected in the strong bearish candle. Sellers are overcome by buyers, and the second candle in a bullish engulfing pattern reflects this price action. Guys, as you see here, both candles must be of opposite color to validate the pattern. Please note that it is always the second candle which engulfs the real body of the first candle. At the same time, it is not necessary that the tails or wicks of the first candle be engulfed. Guys, for both engulfing patterns, you will always analyze them while keeping the below guidelines in mind to filter high profit versus low profit opportunities when these patterns appear. Whether bullish or bearish engulfing patterns appeared after a clear uptrend or downtrend. This means that the importance of the pattern increases when they appear after clearly defined trends in the market. Whether these patterns are also associated to key support and resistance zones on your trading charts. If this happens, you are able to trade these patterns with increased confidence. Now that you have understood these two patterns, let's study them further through some real examples. Guys, here in the first example, we are analyzing daily charts of silver to study a bearish engulfing pattern. The first pattern appeared after an uptrend lasting for approximately 20 trading days, hence making this pattern very significant. Also notice candles of opposite colors in this pattern, and then price declined sharply over next couple of weeks of trading. Similarly, another bearish engulfing pattern appeared on silver after 30 trading days and at the same resistance zone. Notice guys, the large bearish candle indicating the large selling here, and then price plummeted in sharp downtrend following this pattern before it came to a halt at a key support. This is also very interesting and recent price activity on daily charts of gold. The first bearish engulfing pattern was at a resistance zone and gold price continued declining for more than 10 trading days. And then once price reached the key support zone, a bullish engulfing pattern appeared, signaling buyers entering in large numbers at this support level. Another bearish engulfing pattern brought back the strong bearish sentiment in the market, hence offering another strong sell opportunity. This is what I've been teaching you throughout the course, that the candlestick patterns dictate a story around these zones. Moving on to the next example, we're looking at pound and Japanese yen forex chart. Once again, this bullish engulfing pattern came at a key resistance zone. A clear downtrend for almost 15 days also ensured that the sellers are losing control of price at this resistance zone. And finally, price rallied in an uptrend. The final example in this lecture is of British pound and Swiss franc. The criteria remains the same, as this zone was seen at a key resistance zone and large bullish candle engulfing the real body of the bearish candle, indicating the large buying entering the market. Guys, this also concludes this lecture, and I will see you in the next lecture where we continue studying other key candlestick patterns I use in this strategy. Hello once again to all of you in this lecture where I will explain two more of my favorite candlestick formations. Before I begin, I want to remind you guys that the candlestick patterns that you're studying in this lecture are in no particular order, so every pattern carries equal significance in my trading, and therefore there is no pattern that I regard superior to any other. Okay guys, the patterns we are studying here in this lecture are called the signal top and the signal bottom, which consists of one candle each. A signal top is defined as a candle where market posts a higher high than the previous candle and then closes much lower than the opening price of the candle. It is a very powerful indicator of a top formation, hence indicating sellers entering in large numbers. Guys, a signal top is very different from a shooting star. Firstly, the real body of the signal top is much bigger than that of a shooting star. Secondly, it is possible for a signal top to have a very small upper tail or upper wick compared to a shooting star. On the other side, as the name suggests, a signal bottom candle appears after a clear downtrend in price. Then the candle posts a lower low when compared to the previous candle, and by the end of the session it closes well above the opening price of the candle. A signal bottom is a sign of buyers taking control of the market by the end of the session and is a strong indicator of bullish sentiment entering the markets. Please use the same guidelines as we studied above in this lecture to differentiate a signal bottom from a hammer formation. Let us quickly study signal top and signal bottom using illustrations. Please remember that signal top candle's real body must be bearish in color and signal bottom candle's real body must be bullish colored. Guys, for both of these patterns, you will always analyze them while keeping the below guidelines in your mind. Whether signal top or signal bottom appeared after a clear uptrend or downtrend respectively, this means that the importance of the pattern increases when they have come after a prolonged move in terms of both price and time. Whether these points are also associated to key support and resistance zones on your trading chart. If this happens, you are able to trade them with more confidence. Now let us go through some examples of signal top and signal bottom. First example is of US dollar and Canadian dollar, and we are studying a signal top candle on daily charts. Starting from here, this forex pair enjoyed a sharp rally for more than 60 trading days, and then we saw a signal top at a major level which acted as price resistance. Notice the size of the tail and real body of this candle. Both are almost equal in price. These are the key differences you will notice when comparing a signal top to a shooting star. Price declined sharply for more than 70 trading sessions on this pair. Let's study another example of signal top. Once again, this signal top appeared after a prolonged trend in price and time. It was once again associated to major resistance. The real body is larger than the tail, and candle posted a strong bearish close after opening higher than previous day's close. And following this signal top, price declined sharply in a bearish trend. More often than not, a signal top formation linked to key level presents a highly profitable opportunity on larger time frames. Let's continue studying next example of euro dollar, but this time we are focusing on a signal bottom which appears after a clear downtrend. The signal bottom candle has a large real body with a small lower and upper wick and presented a major buy setup on this support zone after a sharp decline, as you see here. And what followed was the retest of this support zone multiple times in this pair before price advanced in a bullish trend. The next example of a signal bottom is of crude oil daily chart. Notice once again the size of real body of this candle, guys. Larger the real body, bigger the preceding price action will be. Before this signal bottom, price was moving in a sideways trend, and then it rallied sharply once the bullish sentiment was confirmed by this formation. Guys, the final example is of US dollar and Japanese yen. The criteria remains the same to test the strength of this signal bottom as I show you here. Please remember that a signal bottom or a signal top which is not associated to clear market trend is not as effective when compared to those associated to clear market trends. Guys, this also concludes this lecture, and I will see you in the next lecture in this section. Hello guys, and welcome to the next lecture where I will introduce you to double bulls and double bears candlestick patterns. Both of these patterns consist of two consecutive candles of the same color real bodies. The key point that you need to remember is that the second candle must close at a higher high compared to the first candle's closing price. The double bulls pattern marks an end to the downtrend and is a signal that buyers are entering in large numbers, hence changing the sentiment from bearish to bullish. While the first bullish candle signaled the possible reversal, the higher closing price of the second candle confirms the change in trend of the market. On the other hand, a double bear pattern terminates an uptrend as sellers enter in large number. The second candle in a double bear pattern must have a lower low for closing price when compared to first candle's closing price. Both of these candles must be of the bearish color, hence confirming the selling pressure in the market. Guys, another thing that I want you to remember while looking for a double bulls or double bears pattern is that you will not invalidate these patterns if there is an inside candle between the two candles. An inside candle is defined as a candle which fails to go past the high or low of the previous candle. I will explain you more about this candle once we get to the examples in this lecture. The only thing you need to remember is that if there is an inside candle after the first bullish candle in a double bulls pattern or vice versa, You will ignore the inside candle and continue studying the next or the third candle to validate a double bulls or double bears pattern. Let us study a typical double bulls and double bears pattern using an illustration. So guys, while trading double bulls and double bears, you will keep the following guidelines in your mind. Whether these patterns appeared after a clear uptrend or downtrend respectively. This means that the importance of the pattern increases when they appear after clearly defined trends. Whether these patterns are also associated to key support and resistance zones on your trading charts. If this happens, you are able to trade these patterns with increased confidence. Now let's understand these patterns using real examples. In the first example, we are looking at US dollar and Swiss franc forex pair to study the double bulls pattern. According to the guidelines we studied, you can see that the market was in a clear downtrend. And then market posts a double bull formation. Notice here that double bulls do not relate to any of the previous candlestick patterns we have studied in this course. While the first candle signaled a possible trend reversal, second candle confirmed it with a higher close. And then the price rallied sharply in an uptrend on this forex pair before a shooting star appeared near this major resistance. Also guys, this is another double bulls pattern here on this chart. While the first candle was a small bullish candle, the second candle was a strong candle with closing price clearly above the first candle in this pattern. The significance of the double bull pattern too increases with the fact that it was seen at a major support here. And look how strong bearish engulfing pattern reversed the trend after a sharp price advance. Now let's look at another example to study double bulls. On this crude oil chart, price was once again in a prolonged downtrend before a double bulls pattern changed the sentiment from bearish to bullish. Please carefully study the second bullish candle as this is an inside candle. So this candle is not considered as the second candle in double bulls pattern here. This is because it failed to go past the high and low of the previous candle. Therefore, in such cases, you will analyze the next candle to validate your patterns. Here it was the third candle which posted a higher high confirming the double bulls formation, and once again price advanced sharply in an upward trend. In the next example of US dollar and Canadian dollar, a double bulls formation appeared just below the support zone after a clear downtrend. And a sharp rally followed the double bulls formation. Now let's study double bears formation through some examples. We are looking at pound and Swiss franc forex chart, and consecutive double bears formation was seen in the recent price movement on the resistance zones. Notice how similar the double bears were to each other, and price fell sharply from resistance zone to support zone on this pair. Finally, the last example is of US dollar and Japanese yen. Once again, after a prolonged uptrend in terms of price and time, a double bears formation brought a sharp decline on this pair, as you see here. and this major decline terminated once a bullish engulfing pattern appeared later. So guys, this also concludes this lecture, and I will see you in the next lecture where we will study the remaining two of the candlestick patterns for this strategy. Hello and welcome guys to the next lecture in section 4, where I will introduce the last two candlestick patterns which also make an important part of the support and resistance trading strategy. Firstly, we will study the long-legged doji. When you look at a trading chart, you will notice various dojis, which is a candle with no real body. A doji represents indecision among buyers and sellers as price moves nowhere during this session. Both buyers and sellers have control over the price at some point during the session before price closes at its opening price, hence making market directionless. However, for this strategy, we are only looking to analyze and trade the long-legged doji, or sometimes I call it as a magic doji. As the name suggests, this single candle formation consists of both large lower and upper tail or wick with almost no or very small real body. Also, you will take trading positions using a long-legged doji both in bull and bear market. When analyzing a long-legged doji, you will always keep the following guidelines in mind. Whether this long-legged doji appeared after a prolonged move in price and time. This means when a long-legged doji appears after an uptrend or downtrend, it reflects the confusion among buyers and sellers, hence pointing to a possible reversal. Whether this long-legged doji is also associated to key support or resistance levels. A long-legged doji seen at a key level offers even higher probability of a trend reversal in sight. Let us study long-legged doji using some examples now. Guys, I'm using US dollar and Swiss franc to study a long-legged doji. From a major level which acted as key resistance on this pair, price declined in a clear downtrend before a long-legged doji appeared on a key level. Notice the extended tails of this doji with very small real body indicating weakness in the market. And then market rallied sharply in an uptrend following the appearance of long-legged doji. This time a long-legged doji appeared after an uptrend. And then market went into a small consolidation phase on daily charts before the larger downtrend began on this pair. Guys, there is another long-legged doji on this price chart as I show you here, which also brought a pause to the uptrend. The fact that it came at a major level made this doji worthwhile as it presented a sell opportunity on this pair. The next example is of pound and Swiss franc, and a long-legged doji terminated the existing downtrend at a key support zone. Notice the large lower tail of this candle signaling sellers were unable to maintain their control over the market. Therefore, price advanced in a bullish trend. The last example is US dollar and Japanese yen forex chart. The guidelines stay the same. After a clear upward trend in price, long-legged doji appears at a key level, hence providing a high profitable opportunity. Please keep in mind that the color of the long-legged doji is not important while analyzing market stop or market bottoms. Guys, this also concludes the examples of long-legged doji as we continue studying the last key candlestick pattern in this strategy. Guys, the last candlestick formation you need to know is called isolated pivots. This is a 3-candle formation which is seen after both an uptrend and a downtrend, just like the Doji. To understand how isolated pivots look in an uptrend, imagine a market progressing in an uptrend and then a candle with a small real body reveals possible weakness in the market. This second candle is also bullish in color but has a very small real body and small lower or upper tails. And then during the third and final candle, a very strong bearish candle with a large body appears, signaling a change in trend. Please note that the second or middle candle must have a higher low compared to the previous candle and the next candle. Guys, exactly the opposite applies during a downtrend for isolated pivots. Isolated pivots are mostly used during sideways price activity, hence they present perfect opportunities when market enters a consolidation phase after a sharp trend. To understand isolated pivots, let's look at few examples. Here we're looking at Swiss franc and Japanese yen daily charts. I will quickly plot the support and resistance zones based on the sideways price activity before we proceed. Notice the 3 candles here, guys. The first candle was very bullish, signaling the continuation of the uptrend. Second candle was also bullish in color but had a very small real body. And finally, third candle was heavily bearish, indicating the new selling strength in the market. The second candle must have a higher closing price compared to the other 2 candles of the isolated pivots to validate the pattern. Let's study another example of US dollar and Japanese yen. Here the isolated pivots presented trading opportunities at both price support and price resistance zones. It is very important that we stick to the guidelines to gain confidence in our analysis. Guys, now that we have finished studying all the key patterns that you need to know, I'm confident that you will use your analysis wisely to achieve your target returns. More often than not, you will notice one of these key candlestick patterns on any trading instruments of your choice, hence offering potential trading opportunities. So traders, this also concludes this lecture and the section 4 of this course. Please go through these lectures thoroughly to understand these patterns carefully, as I promise these are all the patterns you need to know to become a successful trader. And I will see you in the next lecture.